What is the most important story these days? A Fed rate hike, a plummeting British pound sterling, or rising recession risks in the US? I am Jeffrey Roach, Chief Economist for LPL Financial, and in this edition of the Econ Market Minute, I want to give you 3 top insights about major market movers across the globe. So first, aggressive Fed rate hikes will eventually tame inflation. As shown in the graph of inflation and the Fed funds rate, the Fed has a lot more work to do in slowing down aggregate demand and thereby slowing inflation. And the Fed tightening cycles historically do not always induce a recession. But since this Fed is acting aggressively to combat that nagging inflation, we do see rising recession risks in 2023, especially since the Fed is willing to sacrifice growth in their fight for lower inflation. We also know from this graph that historically, the Fed does not tighten as high as the previous tightening cycle peak. This time around, the Fed has already gone past the previous peak and has told us they have a lot more to go. The market is likely still coming to grips with a Fed that is attacking inflation at the expense of healthy economic growth. So overall, we do see inflation rolling over. It's just not yet rolling over in a robust and convincing way. We already saw August and September rents decline in some markets across the US, and imported food prices have declined, along with many agricultural commodities. So it's a matter of time before retail consumer prices will follow. However, in the near term, the FOMC has recommitted themselves to fighting inflation until it's moved back to that 2% long-run target rate. Second, pound sterling hit an all-time low. The Bank of England and the new British government is under immense pressure. After an effort to stimulate a weak economy by tax cuts, investors started to sell off the pound sterling at such a quick pace that for a moment, the price of a pound fell down to $1.07. After the pound sterling did get pounded, the UK central bank needed to come out with a statement to reassure markets and eventually implemented a temporary bond buying program. On the first day, the Bank of England bought $72 billion on long-dated UK gilts to help hold off the wide-reaching margin call that would have hit a lot of UK pension funds. So it's fair to say that the Bank of England may have prevented a modern-day Lehman moment, a term in memory of Lehman Brothers, the first of many casualties at the onset of the Great Financial Crisis. This is worth highlighting because fiscal policy and monetary policy should go hand in hand for maximum effectiveness. In this case, if an economy needs to see inflation easing, it makes little sense to stimulate the economy through tax cuts while tightening monetary policy by raising interest rates. Third, unemployment rate spikes typically imply recessions. Historically, when the unemployment rate rises by 0.5 percentage point above the previous 12-month low, we often see the economy in recession. In fact, this general rule was developed by Claudius Sahm, a Federal Reserve economist. And this turns out to be a pretty decent heuristic, only given a few false positives. Given the Fed's expectations that next year's unemployment rate will hover around 4.5%, we can use this rule to infer, at least in the Fed's view, that a recession is on its way. Well, that's all for now. Continue to follow me and the LPL research team on social media, and take care.